Hello, everyone out there. Thank you for joining us for another Mortgage Leadership Outlook. Really appreciate you joining us for the series. We've been having just some great conversations. But with us today, you've got Robert Senko. Robert Senko is president of ACC Mortgage. ACC Mortgage is one of the first non-QM lenders out there today. So he's going to be joining us because he's actually still doing non-QM. And we'll talk a little bit about that. I know, it's some crazy things going on out there today. We've we've got some stories that we're working on today. So make sure you check out National Mortgage Professional magazine, nationalmortgageprofessional.com, and see what's going on. Tomorrow, we have another great guest coming on tomorrow. We have Pat Stone with WFG. Sorry about that. So please join us tomorrow. Super excited. But without further ado, I'm going to bring my buddy, Robert Senko. Robert, how are you doing, buddy?
How you doing, Andrew?
So I'm good, man. I'm really good. Just relatively speaking. It's funny. We were just talking about the new norm of what's good, and like we're it seems trivial to complain about some of the things that that are impacting us when so many of us are going through just there's just people sick, people we both know people that have passed on. So it's just ugly, and we're working with a situation in the mortgage business that's just, to say it was unprecedented is, is just the understatement. One of the things actually that people actually have talked about is that non-QM is one of the things that we lost. That non-QM, people have talked about that the death of non-QM is upon us, but you don't believe that, and especially actually the people taking files from you and sending you files don't believe that. Talk to us a little bit about actually the current state of non-QM, and then I want to go down to history of how you got into non-QM. So Robert, thank you.
Well, I appreciate the time, Andrew, and thank you for calling me from your bunker, and your studio. I'm glad that I could share the message and hopefully offer some hope to the mortgage industry for non-QM as product in the mortgage industry. So, just a quick story. My background, I started in the early 90s lending. We called it, equity lending, B and C, subprime, non-prime, non-conforming, and it went to Alt-A. The core link of successful lending has been, skin in the game. That's in the early days when I started back in the 90s working with Cityscape. People were putting down 25, 30% into the loans. And, fast forward after the collapse of 07, 08, and then the rebuilding of the non-QM, there's still a lot of equity. So this is not a repeat of 07, 08, which was just overly highly leveraged. People are putting down real dollars into these products. So this is not a product-driven collapse. This is really a capital market collapse that's more akin to the long-term capital management debacle of 98, 99, the Russian ruble, when capital became a premium. And that's what happened. And this is unprecedented in our lifetime. Maybe the Spanish flu, we could talk about that, but I know you were just a young buck back then. In the 1920s. But, today, this is just capital market liquidity and in hoping that seeing how, people are losing jobs. I mean, almost 10 million people in the last 2 weeks have filed for unemployment. We'll see what the coming weeks bring and how this plays out until we get back to a normal, economy. I think the government's doing a great job in providing funding for small businesses, providing some safety nets for those that are being displaced. So I think, when those restaurant jobs, when those service industry jobs will come back quicker, but focusing on non-QM, I'm not an economist. I'm a mortgage banker. Really, I'm just a glorified loan officer. I just have the title of president, but the product is still fundamentally good. When somebody is willing to put down 20, 25, 30% into a mortgage and buy a home or put up the equity that they built up, the likelihood of that performance is outstanding. And that's where non-QM is built upon, is that skin in the game. That's what got lost in the 07, 08 time frame when you had 100% stated income. I think Dodd-Frank did a lot of good things that forced the industry to look at ability to repay. So, once the dust settles, and assuming people are working and they are working for companies that can sustain themselves and they can sustain, people will be able to buy homes and move up and sell and refi and tap into the equity. Where the values fall, who knows? Who knows where the market goes? But this product is not going away. I know there's probably some loan officers out there that were left at the proverbial altar by their lenders when funding got pulled back and liquidity, dried up 2.5 weeks ago. Yeah, there's some of those war stories, and that happened back in 07, 08 during the implodometer days when that was all going on.
Sure.
But non-QM as a product is not going away, and I think my hope is when we get through these next 3 to 6 months, we're going to see that a lot of this paper performs. Sure, there's going to be some slow pays, forbearance, and the states and the government are putting in place, but you're going to see these loans perform. People need to work. They want to work. They get a sense of accomplishment. The fears that, these safety nets are going to create a lazy society. I don't buy that. I think Americans, we want to work. We enjoy work. We enjoy the challenge. And some people need a break, and they're going to need a little pause, in the short run. But, those loans will perform over time. I don't think you're going to see a cratering of values. You might see a little pullback, but by and large, non-QM is here to stay. Some of the peripheral products, maybe some of the DSCR investment properties, they may not perform as well. Because for the simple reason that, those products, if someone's going to pay their mortgage, they're going to pay their primary before they pay an investment property. And that's just historically a truism. Those were a little bit of a race to the bottom, those DSCR products. I don't mean to disparage any of my competitors, but those products, became too streamlined. We were, I think, lowering the bar on those, where they started out at 70%. They were going to 75, 80, and then 85. You had the product creep, as I like to call it. And, if I could, a nefarious creeper of the products coming up, you saw a little bit of that. But the owner occupied, those were high standards, high, credibility with those loans. So I believe when the dust settles, and then that will prompt, as the capital markets, the securitization market to come back in. Is that 3 months, 6 months, 12 months? That's anybody's guess, but the product will be there, and we're continuing to lend. We've shrunk our box a little bit, so we're only a maximum of a 75% LTV, but there's still financing out there, and we've gotten busier with some of our marketing campaigns. People are coming to us. We're talking to a lot of displaced account executives, so it's an interesting time. There's still tougher deals. There's still some pain that we're going to experience as a country. But I do believe that, given a relatively 3 to 6 month period, we'll be back to some normalcy and, in better times and healthier times.
Wow. That's so, and we're all hoping it's sooner rather than later. And a couple of things. But by the way, I'm just curious from the people that are watching this, if you've ever done a non-QM loan, just let us know in the chat. You can just type in non-QM or I have done a non-QM loan. Just let us know if you've done non-QM loans. So actually, I'm going to start off with a question from my dad. Good. I'm glad actually. But yeah, Joel says, what secret sauce does ACC have to be one of the few last men standing in the non-QM space?
Well, Joel, if I told you that, I'd have to kill you. I mean, no, it's actually very simple. It's prudent underwriting. We didn't over leverage ourselves. Every collapse, you can go back to the S&L crisis. Every collapse has been prompted by over leveraging. So part of ACC's secret sauce is that we didn't over leverage our balance sheet. So do we have a little collateral damage? Absolutely. But the way we finance and sold loans and package loans, we're not going to experience too much collateral damage. So the secret sauce is don't spend more than you have, and don't over leverage yourself, Joel.
No, great. So what's left? What are the products that you guys have left, and what do they look like?
So not too dissimilar from what we were doing previously. As I said, DSCR, the investment product, that's on a hold right now. I think that'll be that'll come back at some point, but right now that I don't see that jumping back into the fray, because no one knows how these loans are going to perform.
Yeah.
When they were predicated on rental income. Who knows how they're going to pay? And, they could lose 3 months of payments if people are, forbearance and rent forgiveness or rent deferment. But we're still doing 75% ITIN. These people are laborers, they're workers, the blue collars. I've shared some of these webinars. So that market's still very viable. The self-employed borrower is very viable. Again, 75%. You're putting up 25% of that purchase price. So you really hope for the market, the invisible hand of the market. So if you're Andrew Berman, the self-employed person, which you are, and you want to buy that home, and I say, all right, Andrew, I can get you that $400,000 home. In your case, it's $4 million, but for us lay people, and you're going to put up $100,000 of your hard-earned capital, your savings, your money to buy that. Well, then you've got to have belief. I can prove your income. I can see that you've made money. But if you're willing to put that up, I'm willing to put up $300,000 to your $100,000. So that's where, the relationship works together. And if values go down, and let's say that house next year is only worth $350,000, well, that $50,000 loss is coming from you, not from me. And I think that's what got lost in the run up to 07, 08 is the lenders bore all the risk. There was no risk by the borrower. Yeah. So at this point, when you're going to buy that home and you put up that money, you're showing me and you're telling yourself that, hey, I believe in my future. I'm betting on myself. I'm betting on my history. And I have enough reserves to weather the storm if need be.
Yeah. So I got to ask, what is the mentality of the people that you're working with right now, the brokers? Like, I mean, because I'm talking to a lot of people. They're there's business being done. It's usually, a lot of refis, but talk to us a little bit about, the mentality of the brokers that you're doing business with. And then we'll address Stuart's question, but if you don't mind.
So, talking to brokers and mortgage professionals, there's really two camps. I think there's some people that recognize the opportunity with non-QM as it relates specific to non-QM, that, there's less competition out there. And then there's people that are shell-shocked, that I can't believe that this has happened. So I think the average loan officer is very busy with their low cost refinance. The rates are attractive. So they're not thinking about it so much, but there was a lot of people, as I said earlier, that were left at the altar that didn't have these outlets. So our phones have been ringing off the hook. Wow. Which has been exciting for my staff, and the temperament that they have and how they're feeling is, boy, this is a great opportunity that my competition is no longer around and we're still here. We're the oldest non-QM, and we're one of the last standing non-QM. Now, I think when the market turns around, people will come back. Some of these companies will be back.
Sure.
And I hope so. That shows to me that the market is healthy, that the capital markets, I'm not so greedy that I believe ACC is going to be the only one, nor should we be the only non-QM lender. The banks and other institutions will come back. I just want to be one of the leaders in the industry. And I think that's where, as a company, we're very excited by the prospects. It's not this month, it's not next month, but it's really looking 3 to 6 months into the future for the opportunity.
That's great. So let's answer Stuart's question. Is it taking longer to close loans today?
No, if anything, it's maybe a tad quicker because it's not as much volume. Our volume is definitely down in this newer paradigm that we're in, but it's just as easy. We're scrutinizing. The one thing that I would say that is different, what I call BC, before Corona, now we're PC, post Corona, is, we're really looking at the viability of the business, of the job, of the employment. Is this someone that's going to be around down the road? I think that's an important distinction that we're really looking on. And that's a little subjective. That's a little difficult sometimes to measure, but it's something that we're cautiously looking at.
So I'm assuming restaurants you guys are probably staying away from. What are some of the industries that you're trying to step away from, and then tell us the industries that you see the biggest opportunities in?
It's all over the board because you have different consultants. I have realtor friends of mine who are writing contracts and closing deals. I was thinking, real estate agents would be tough. There's still activity. People still need to move, and their, listings have gone up. Restaurants are probably the toughest because those, bar restaurants. I have several friends who own restaurants that are either shuttered or in limited capacity. But, I'll always bet on the entrepreneur because what they're also finding is that their takeout business is doing very well. So they've reduced overhead so much that they can sustain and keep the lights on. And if they work with some of their creditors, they can ride this out. So they're actually doing okay. They're paying bills. They're allowing, some of their people have had to file unemployment, but the business itself can be on life support for a few months, another couple months. And I think, coming into the warmer months, people are going to want to go out. I don't foresee sporting events coming around anytime soon. I don't think large gathering, but I think people will want to go out and have a glass of wine and a beer and go sit in their, corner pub and at least just be around in proximity to people. I think there'll be some, social distancing, socializing in some of those places.
Yeah, it's going to be weird actually, to go back to these places. Just talking earlier, like in restaurants, we will go back to restaurants, but are like in Manhattan where you're on top of each other. It's going to be a completely different dynamic. So Karen wrote, are you allowing new brokers to sign up to do loans with you today?
We are. We admit, there's a point where we pause. We have a lot of brokers that have been loyal to us, but there's such a demand out there and an opportunity that, yes, we are bringing on new brokers.
Yeah. Yeah, well, that's good. That's good. Glad to hear that. So, actually, another question from my dad. Do you have any question? Do you have any suggestions for marketing to an eligible demographic that requires non-QM loans? With today's revised marketplace. So, how do you get out there with your message today? And it's I talked to some people actually that are saying that their sales staff is doing great just because there's just such great opportunity and people are home and they're looking for interaction. And I've also talked to some people actually that said that their production staff are like a deer in headlights where they're frozen. They feel like it's a weird place to call someone and talk about refi. So any suggestions on how to market yourself today?
Well, we've always been another tool in the proverbial tool belt for the loan officer. So, loan officers they know DU, they understand whether they're an FHA shop or DU. Non-QM, lends itself to the non-traditional. So when you find that self-employed borrower who maybe their tax returns, they had a loss carry forward, but the business is making money and they're generating money, those are the clients. So, it's always been to Mr. Berman, the non-QM, whatever you want to call the name, has been that additional tool. You try it, it becomes a waterfall effect. You go to your top jumbo company. Well, nope, doesn't fit here. Now it fits here. The bank statements, the tax returns don't support it under the traditional, but ACC over here, because you're self-employed, you've been doing this 2+ years, you're putting down that 25-30%. You're looking to, upgrade or move into a new home, buy that second home in Florida, you can get qualified for those. So again, it's not, the joke I always use, I wasn't my wife's first choice, but I was her best choice. So, that's how non-QM is.
That's great. I like that. I'm gonna. By the way, I'm stealing that from you.
You can.
Definitely. Yeah, I'm gonna take that. That's great. Talk to us a little bit about ACC as a company. So you're in your office now. I don't know. Are you alone? Is there anyone else in your office? Because you've always been. Most people come to the office, right? You're not a work from home kind of organization.
We have a number of people. We have a number of our sales staff is around the country. Some of our local support staff, they didn't feel comfortable. They wanted to work from home, so I wouldn't impress upon. They just take their computers with them, plug in, and they're ready to go. I think 2 reasons. Number one, my wife needs me to get out. Going to my earlier point, prior to our earlier discussion, and number 2, I just feel. For me, it's anybody who works in their home, I have a great deal of respect for, because when I did this years and years and years ago, when I first started, I struggled because I never felt like my day began and I never felt like my day ended. So after doing that for about a year or so, I went and rented a small office just because I needed a place to get in my car, go get a cup of coffee, a bagel in the morning, and get to the office. So when I came home and I watched TV, because I'd hear my fax, this is when we had fax machines, going off in the middle of the night or later, and well, let me go in there. It was too distracting for me. So I have a great deal of respect. For me personally, I need to be here. So I'm maintaining some continuity of my schedule. And, when I go home, I can focus on the family, and the weekends enjoy the family and the kids.
Yep, I know you. You always. I've been someone next to who has that distance. Has the separation of the work life and the family life. Whereas, and for now, many people, it's merging together. So I was just upstairs hanging out with my kids, helping them make a video. I've got a little more work down here to do, and then we're gonna go for a bike ride, and then I'll come back down here. So it's kind of like a merging of the two. Now, do you find actually as your your processing staff been just about the same, more or less productive in the new work from home environment?
So we have all of our most of ours, with the exception of one processor, was all remote. So we made a pivot about a year ago to expand. I was never a believer in that, and I hired a new ops manager, and he was a big proponent of remote employees. I had never done it, so to me it was new and foreign. We had some great success, with some processors. So for us, this was kind of seamless, as well as a lot of our underwriters as well. We have some of our now closers are working remotely and set up people, but by and large, it doesn't change. It's a little quiet here in the office, but otherwise it's business as usual for us.
Wonderful, wonderful. So we got a question from the audience here. Gerard Simmons, would ACC Mortgage ever consider expanding beyond QM?
No,
not QM, but yeah.
I get the question. No, I'm not good at it. There's a lot of companies that are better at the QM space. I like to believe I'm pretty darn good at being, a non-QM expert. So that's where I want to focus my attention on and let people know when they think of non-QM, they're going to think of ACC Mortgage. And I hope even more so after this kind of post-corona world that we will, come out as a leader in this space.
Wonderful. Wonderful. So next question for my own team. As a leader in the non-QM, where would you like to see the industry go when the economy starts to return to normal? What are some practices? Do you think non-QM lenders should value the most?
You're asking me to give away your secret sauce. Is this your dad? I mean, it's
not my dad. Listen, we're always trying to get inside your mind and share your great ideas with the industry out there.
Your dad's writing notes. I think, as I said before, non-QM was born out of, and again, we lent continuously from 07, 08, 9, 10, we always did non-QM lending, going back to 99. So what's going to be, what is going to force the capital markets? Because it's not what Robert Senko wants. It's what the capital markets, what do the Credit Suisses of the world, what are they looking for? How are they going to get behind this? How are the institutions going to invest? And it's always going to come down to one fundamental. It's going to be, is that borrower willing to put skin in the game? So as long as you have that, you're going to have non-QM availability. We have it now. I mean, we're on the dust hasn't even settled, but yet we're still lending because fundamentally we're asking for, real money into it, 25 to 30% down. We're asking for reserves. And if you're willing to make that risk, well, you're going to have that. So I don't think anything's going to change. It's going to be the appetite for that. There's also going to be an analysis of the, these securitizations that happened, what performed, what didn't perform. So this will be the kind of real life stress test for the industry to show, well, these loans performed. This person, that had 9 months of reserves outperformed the one with 2 months. That was a big indicator. That was not as big an indicator, but the 70% really performed well versus the 85 or 90%. People kind of did the throw up their hands that happened after 07, 08, which I don't think anyone fully expected that. It makes sense in hindsight, but at the time, well, people aren't going to walk away from their homes. They did, and I don't expect that's going to happen today because people have invested real money into the transaction.
So we're talking about actually, when we look at 2008, I mean, obviously the 2008 was caused by the financial, we did it, but everyone did. So credit rating agencies, everyone, it was something that was, you mentioned 98, long-term capital management failed. So that was an external force. So this is something that is completely external, but could have actually, an impact actually on the securitization of any future non-QM products. And no, not could, but will probably. So, I mean, you're talking about actually, these deals, why they make sense, while it's your people have skin in the game. They're businesses that are not necessarily impacted by this. But do you think actually that there could be that we could see more fatalities of products or tightening of actually standards as we're going through actually we're seeing a shortage of liquidity for across the board. It's not just non-QM. Obviously, non-QM was the first thing that took the hit. But what are you nervous at all? I mean, that's really what I'm trying to say. Because when the world started falling apart, you and I were talking, and you were hanging out at the beach, and your voice was relaxed, and I was like, "This is great." I just got off the phone with actually someone who was saying actually that they were that it was as ugly as it's going to get. I had the scariest call with this person, and it really sent shock into me. Then I had a call with you. you're hanging out at the beach and saying, no, we're still doing non-QM. And we were talking about what we could do to help get more people on ACC. So talk about actually why you're so cool and relaxed about actually the non-QM space.
Well, probably because I drink a lot on the weekends, but that aside, at that time, again, I knew, I wasn't over leveraged. So for me personally, and as a company, I recognized that the company was fundamentally sound. So that gave me confidence. I also know the fundamentals of the lending do work. Now, the nervousness comes from how are loans going to perform? And I think part of what you already read about and what exasperated the problem in 07, 08 was the mark to market, was what they call TDR, troubled debt restructuring at the banks. So you had people, now we did some subservicing for a local community bank. So let me get a little nerdy, wonky technology. So they had a portfolio of loans that they had bought through Countrywide. And these loans didn't perform for a couple of reasons and, had cratered. And the bank said, gee, we don't have a mortgage division. It was a bank I actually looked at buying with some partners. We didn't. So I would go to them and I said, great news. Whatever happened had changed for these people. They're able to start paying again. If we give them this interest rate, we weren't, like reducing their debt. We were just kind of creating a new structure for them. And there's weird accounting rules. And, I didn't take too much accounting in college, but the rules for the community banks and banks in general, that would be classified as a TDR, a troubled debt restructuring. So all that money had to be reserved completely differently. And it exasperated the problem of an already struggling bank. So I don't understand. I'm not that smart and I'm not a banking, expert. So I've already read that the banks are going to, or the regulators are going to be a little bit more forgiving of these TDRs. So if you have someone that has, goes a couple months down, that they're not going to penalize the banks, because that's what exasperated that mark to market and the ability to work with people. Because there was a lot of people that I talked to. It wasn't a big pool of loans. It was only about $30 or $40 million. But I was working with them. I had my team, and then I would get in and help negotiate. And they were like, great, we can afford this. Here's my pay stub. Things went sideways. Great. And then I went to the comptroller and said, can't do that, because that would create a hit on our balance sheet. So it was like a self-imposed penalty. And I think there was some lessons from that. And Dodd-Frank has helped prevent a lot of that. So that's why I don't have as much fear. I think there may be some rocky days ahead. You hear with the servicers and how those performance and the liquidity on that side. But I think these are a lot of accounting treatments. I think fundamentally the way we've evolved as a portfolio lender as well is I need to make sure that my investors get paid back their money. If we've got to renegotiate, restructure, put stuff on the back end and maintain the principal and work that, I'm not held to those rules that the banks are. So I think that's part of the differentiation.
Yeah. So, but what also the conforming marketplace and the government marketplace has is they have actually, the GSEs and FHA and VA to kind of be as like a backstop. Now, for private labeled securities, we don't have that, and so private labeled securities, what are the large servicers of loans that are non-QM loans? Where are they feeling that how are they going to withstand a year of no mortgage payments when the bondholders are going to still want their principal and interest?
I mean, that's a little above my pay grade, and if it's going a year, then we got deeper issues. I think there's going to be a temporary pause where everybody aligns, and bondholders, creditors, I think everybody's going to get in line. I think CMBS is, and again, this is just, my general, layperson opinion. They're going to have to do some, soul searching and negotiation. So I think if you don't force the issue and you let people work it out, and with your landlords and creditors and bondholders, I think everybody can get to that place that they're comfortable. And with the government, they've already committed $2 trillion. I expect another $2, maybe even $4 trillion to come behind in other stimuluses for small businesses and various industries to support them and prop them up while we become more normalized again.
Yeah. It's listen, everyone's talking about actually making sure that the Fannie, Freddie, and Govy products are like they're taken care of, but no one's talking about the non-QM products. How we're going to help those servicers. Those servicers are going to, because they're going to be faced with the same forbearance requests. So we've just seen like ridiculous amounts of requests going into those servicers. It's something that's of great concern of the entire industry. But to your point, listen, these products are great. They're not going to go anywhere just because they just make sense. When you have skin in the game, when you have people that have shown actually the ability to repay, and have an industry that is not going to go any place. It just makes sense to lend the money. So personally, how has this impacted you? You're here in your office, but what are some of the things that have changed for you personally that have really hit Robert or the Senko household?
Well, it's Senko household and business. Immediately cutting expenses. Cutting both personal and professional within the our world. Some of those extraneous. We were forced out of our, spring break like everybody else was. But it's a time to retrench and look at, fortunate to have a roof over our head and be able to provide for the family and, and maintain the space here. But I think everybody's got to, take a step back and see where this plays out. And that's, easier for me. I know a lot of people do struggle paycheck to paycheck. We furloughed some people, and said we've got to see where the volume is. I actually had someone just stop by now and, they're interviewing. There's hiring jobs, there's hiring at, guess where, the SBA, approving SBA loans. So there's opportunities in every crisis. There's always been opportunities, that people don't see in the moment. So, having been through this, and as we promote not just non-QM and ACC, and I appreciate the audience that you give us. There is the ability to go out and see where the next opportunity is, and it just becomes a matter of timing. That's, to me, this is not the end of the world. We're not going into a zombie apocalypse. It's really about when does the world become more normalized and we rebuild. And, they talk about a sharp V, we're going to hit the bottom. A lot of people laid off, in those service industries, but how quickly can they rebound? It's not going to be at the heights again. And it's, we're not going to hit those tops of the stock market, but I think there will become a normalization. And particularly if we have some medical advances, which you and I aren't qualified to even discuss, but everything that we read, if people can feel like, gee, if I get this, there's a high likelihood that I will get this medicine that will prevent me from having anything more drastic. And we've got to look after our elderly and those folks. But I think for the youth and the people that are working, we need to get back to work, and we will shortly. It doesn't need to be today. You recognize it, but at some point there will be a normalization. And once that happens, where does the opportunity? And I think that's what we're looking for. I came out of college. I don't know your age. I think you're a little younger than me. But when I went in 1987, the economy was roaring. Jobs, you go to college, it was like you got a ticket. I came out in 91. We had the S&L crisis. We had, it was the world completely, flopped. I had friends who didn't work for months, didn't have a job. I was fortunate. I was in marketing and sales promotion. So I had a job when I graduated, and then I came into the mortgage industry. But, it was a tough economic times. In 4 years, the world completely changed. But the world improved through the 90s. We had some of the, the late 90s innovations, and then 9/11. So there's always been opportunity. And I guess at 50 years old, I have a little bit more perspective now, and thinking about the Jimmy Carter years in the 70s. I remember those. I remember the Ronald Reagan years, and how the country came together in 84, and things were unbelievable 84 to 87. So this is natural through it. When it's your first time, and my children, it's probably a little unsettling, and some of the younger people in the industry, this may be unsettling, but there's always light at the end of the tunnel. And I'll bet on capitalism every day.
Me too. Money well placed. Wonderful. All right, Robert, thank you so much for joining us. We really, really appreciate it. We've got a webinar coming up next month in May that we're going to be doing with you, which I'm super excited about. On that webinar, what are you going to cover?
So we're going to cover a little bit more about what we talked today, and I'm hoping by that time I'm going to have a few more products and some institutions that we are looking at, so we'll be able to expand our box a little bit more. Just talk about get into a little bit more of the details of the products. We glanced over it a little bit, talk about the ITIN, talk about the profit and loss programs that are available, the bank statement. So we'll get into that, and hopefully a little bit more jumbo, maybe have some investment products available by then. So I'm hoping to see a little movement in, the product offering in the capital markets. So it's a month from today, I guess, right? It's a month from today.
Yeah, fantastic. So, and if you're one of our fans, you'll find it. It'll be on social. Make sure you can go to our website. You can sign up for our newsletters. We'll make sure we email you about it. And that's about it. So everyone, please, Robert, first off, thank you so much for spending time with us today. We really appreciate it. I know you're dealing with a lot, actually, with people trying to get deals done, new broker sign up. So we really appreciate you taking the time to meet with us today.
No, thank you for having me. Wash your hands and be safe.
Wonderful. And once again, this is Andrew Berman from National Mortgage Professional Magazine. We thank you so much for joining us for this series that we've been doing. We've been having a great conversations, just trying to get leaders like Robert to join us, trying to talk about what they're going through, share some kind of messaging to you, because right now this is the time just to do everything we can to communicate with our audience, with our employees, with our community. Just let them know what's going on. National Mortgage Professional, we continue to try to be everything we can to try to let you know about what's going on. We've got a couple of breaking stories that we're working on right now. So go to nationalmortgageprofessional.com. Check it out. If you're not signed up for the NMP Daily, you'll have an opportunity to join us. And everyone, stay safe. We will see you tomorrow.